Hi, I'm Kunal, and in this video, we'll be talking about two very important strategies that people generally use in the options market. One is the bear put spread, and the other one is the bull call spread. All right. In the bull call spread, the strategy basically revolves around when you are bullish in the market, but not that very bullish. All right. Likewise, when I talk about bear put spread, here you are bearish in the market, but not that bearish. All right. So for bull call spread, what we'll do is we'll have this entire payoff graph. We'll understand it, understand the maximum profit that you can gain out of the strategy. We'll understand the break-even points. We'll understand the maximum loss that you'll be making in this particular strategy, and we'll see what legs you need to buy of the call option. All right. So when you make bull call spread, you only need to play around with the call option. That is, you only need to buy and sell call options for different strike prices. And when you play around with the bear put spread, you only need to play around with the put option. You need not include the call option when you're talking about the bear put spread. All right. So talking about the bull call spread, say for example, today we are standing on 7th of June 2023, and the current spot price of Nifty is 18,700. All right. So that is the spot price, and we are looking for this particular strategy for the expiry date of 29th June. All right. So on 29th June, I am planning to buy, not buy exactly, but I am planning to transact two options. One is for a strike price of 18,800, I'm planning to buy the call option. All right. So for a strike price of 18,800, I'm planning to buy the call option for which I am paying 30 rupees. And for a strike price of 18,900, I am selling a call option for a price of 20 rupees. All right. So initially, what is happening here is for a strike price of 18,800, I'm buying the call option and I'm paying 30 rupees out of my pocket. And for a strike price of 18,900, I'm selling the call option, and the premium, since I'm selling the call option, the premium that I'm getting is 20 rupees. All right. So 30 is something that I have paid out and 20 is something that I have received. So net, I have given 10 rupees in this particular strategy. All right. 10 rupees in premium is something that I have given to the markets. Now, what I need to understand here is, in case if you would have made only a naked call position, if you would have taken only a naked call position where you would have gone long call for 18,800 and would have paid 30 rupees for that call option, basically the amount of money that is going out of your pocket is very high. It is 30 rupees per quantity. All right. But the moment you sell a call option for a further strike price, all right, you get some money in return, and the net outflow from your pocket comes down from 30 rupees to 10 rupees. So that is the idea. So with both these strategies, the idea is to reduce the outflow of premium in your from your pocket. All right, since these two strategies are involving a buy leg, and since whenever you buy, you basically pay money, and to reduce that payment outflow, you take another leg, that is of a sell position, so that you get some premium out of it. All right. So 18,800 is something, is the price for which you have bought the call option, and 18,900 is the price for which you have sold the call option. Now let's understand how the break even would work out, the maximum profit would work out, and the maximum loss would work out. All right. So today we are standing at a stock price or at a spot price of 18,700. Now this, let's say this moves in the upper direction. It moves from 18,700 to 18,000, say for example 850. All right, 18850. So in this case, your first leg, all right, that is the call option that you have purchased, that comes in the money, and it is in the money by how much rupees? By 50 rupees. All right, so 50 rupees you are in the money, and 10 rupees you have paid initially, all right, to make this entire strategy. So net you are gaining 40 rupees for a spot price of 18,850. Now let's say the stock price move further to 18,900. In this case, you will be making 100 rupees. All right. Since you have a call option for a strike price of 18,800, you will be making 100 rupees. But since you have paid 10 rupees from your pocket, you are net making how much rupees? 90 rupees. All right. So that is the maximum profit that I have written for you here. 100 rupees is something that you are making at what price? At 18,900. All right. So 18,900, say for example, is a spot price. You already have a call option that you purchased for a strike price of 18,800. So that is your net difference. That is 100 rupees. And from this 100 rupees, you need to deduct for 10 rupees, because that is the initial outlay that you have made to buy this entire strategy. All right. So that is your maximum profit. Now, in terms of break even, what we need to understand is the price point where you're neither making losses nor you're making profits. So the break-even price here, I have calculated it as 18,810. All right. If you use any broker, say for example, you use Dhan and you go to the options trading platform, it would automatically find the break-evens calculated for you. But I'll simply explain you the logic of this break-even price. All right. So it's 18,810. Say the spot price is 18,810. The first leg is in the money by how much rupees? By 10 rupees. All right. Now, since you are in the money by 10 rupees, you're making 10 rupees. But to make the strategy, you had given how much rupees? You had given 10 rupees earlier. So, net, you are not making anything. That is a zero. So, that is how the break even has been derived. That is 18,810 is the break even that you have come across. All right. So, maximum profit is done. Your break even is done. Now, what you need to understand is you also limit your losses in this particular strategy. All right. So when I say you limit your losses, now say for example, if the stock price starts to go on the lower side, all right, from 18,700, it goes to 18,600, 500. So in this entire case, this strategy is of no use because neither the first leg nor the second leg obviously will be in the money. All right. So in that case, the maximum loss that you can incur here is the premium that you have paid, and that premium you have paid here is 10 rupees net. All right. In case if the stock price goes to as high as 19,000, even in that your maximum profit would remain constrained to 90 rupees. Reason being, whatever gains you are making in the first leg of 18,800, after the stock price crosses 18,900, your profits would get nullified. All right, from the first leg and the second leg. We can simply take an example here. Say for example, we take 18,950 as the spot price. In this case, you make 150 rupees in the first leg, but at the very same time, you lose 50 rupees in the second case because you have sold this call option. So the person who had bought the call option for 18,900 would make 50 rupees out of it, and you have to pay that. So 100 rupees is net you are making here. But again, to make this entire strategy, you had given 10 rupees initially. So that brings down your total profit to 90 rupees. So that is the idea, and that is how it works around entirely. Now, have you understood bull call spread? In the very same way, you can understand bear put spread as well. All right, in the case of bull call spread, you were bullish, but not that very bullish. You were of the assumption that yes, Nifty would cross 18,800, would might touch even 18,900, but you were of the opinion that nahi, usse upar to nahi jayega. All right, but in the likewise in the case of bear put spread, you are bearish about the markets, but not that very bearish. So say for example, the spot price is 18,700 right now. Again, you make two legs here. You buy a put option, and at the very same time, you also sell a put option. All right. When you're buying the put option, say for example, you buy it for a strike price of 18,600. So at the very same time, you also sell a put option for 18,500. All right. Goes without saying, the put option that you have bought for 18,600 would command a higher premium because it is nearer to the strike price, to the spot price, and the put option that you have sold, that is for 18,500, would command a lower premium because it is further away from the current spot price. Again, the date of expiration is 29 June. We are standing on 7 June as mentioned earlier. All right. Again, we can figure out the 3 points that we need to understand: the maximum profit, the break even, and the maximum loss. Again, the maximum loss would be constrained to the amount of premium that you have paid here. So in the first case, again, you are buying the put option for 18,600. So the premium that you are paying is 30 rupees. In the second case, the premium that you are getting is 20 rupees. All right, because you have sold the put option. So net 30 minus 20, 10 rupees is something that is going out of your pocket. So that would be your maximum loss in case the stock price goes on the upper side, it goes to 19,000, 19,100. This entire strategy is worthless, and you would incur the maximum loss of 10 rupees. Now, in the case of maximum profit, the maximum profit that you would make is 90 rupees. Again, the reason is very simple. Say for example, the stock price starts to go down. It comes down to 18,500. In that case, in the first strategy, you will make 100 rupees. All right, because it has moved down from 18,600 by how many points? By 100 points. All right. And at the very same time, you incur 10 rupees, to make this entire strategy. So net you are having a profit of 90 rupees. Now, any price that is below 18,500, your profit would remain constrained to 90 rupees. Reason is pretty simple. We can take an example and understand that. Say for example, for a price of 18,000, in the first strategy or the first leg, you would make a profit of 600, but at the very same time in the second leg you would make losses of 500 because you have sold the put option. All right, so net you're making 100, and in this case again, out of this 100 rupees, 10 rupees are already paid as premium to make this strategy, so you'll make 90 rupees. So your maximum profit is clear, your maximum loss is clear. Now to understand break even, again, we need to understand, understanding break even is very simple. You need to simply have the initial outlay in your mind. All right, so the initial outlay has been 10 rupees in this case, and you need to calculate the break even, you need to understand that when you'll start making money. Here in this case, you'll start making money when the stock price goes below 18,600. So how much does it need to go below 18,600 for you to start making profits? By 10 rupees. All right, because the initial outlay has been 10 rupees. So 18,600, below that you start making profits. So 18,590 is the point where you start making where the things break even. So let's take an example. 18,590, you make 10 rupees of profit in the first case. All right, this strategy is of no use as of now, or this leg is of no use as of now. You make 10 rupees in this case, but you have also paid 10 rupees to make this entire strategy. So net you are not having, or you're not gaining or losing anything here. So that is the whole idea. That is how you need to understand bull call spread and bear put spread. In the very similar way, you can also create bear call spread. There could be a bull put spread. All right, those are pretty simple. Once you understand this, you'll understand that as well. But this is more so about the basic strategies or the pre-built strategies that we generally speak about in options trading, where in case you have formed an opinion about the market, or if you're after your research you're pretty sure that the market would be moving in a certain direction, but are also of the opinion that the movement would not that be very high, or are of the opinion that the stock price would move, but you do not want to risk so much of your premium amount, or you do not really want to pay that much premium to create or take a naked position. So this is naked position as in on the long side. So this is the strategy that you can easily apply. I'm hoping that you've understood this particular example, and all you can do is learn more about options, learn some advanced strategies about options. If you gotten a knack of it and you can develop further strategies on options, you can easily do it using a platform Upsurge, where we have more than 5 to 6 courses only on options trading, where we are discussing more different strategies about options. So that is what you can do. And at the very same time, in case if you want to systemize your options trading strategy, all right, that is where our algo trading or system based trading strategies come into the picture, which also you'll find it on the platform. So I'll be seeing you in the next video, where we'll be discussing further bookish strategies and how you can simply apply them once you understand how the 3 points of maximum profit, break evens, maximum losses, and all those things work around. Thank you.